India's macros have taken a 180-degree turn since the Reserve Bank's Monetary Policy Committee met last on October 5th. The rupee closed at 74.06 on that day, and in the previous 1 month, it had fallen over 4%. From under 71 per dollar, it had gone on to 74 plus. It's a different story now. The dollar rupee stands at 69.7, having risen 5% throughout November. Likewise, crude. Crude was at $85.2 per barrel on October 5th, the day of the last policy, having risen by 13% throughout the month of September. Now, crude stands at $58.7 per barrel, having fallen a full 20% in November. Last time, the MPC had just shifted from neutral to calibrated tightening, braving any call to hike interest rates by saying we are not bound to hike in every policy. And now it faces accusations of keeping real rates very high. So what will the Monetary Policy Committee do on December 5th to discuss exactly that? We have CNBC TV18's Citizens Monetary Policy Committee that shadows the real committee. Let me invite Chairman Pranab Sen and members Sonal Verma of Nomura, Sajid Chinoy of JP Morgan, Chamaran Chakraborty of Citi, and Soumyakant Ghosh, Chief Economic Advisor at SBI. Okay, well, let me first go to the lady. Sonal, what do you expect the RBI will do to its inflation forecast? Given the sea change in fuel prices, what will it forecast for inflation when it meets on December 5th?
The inflation numbers actually were undershooting the RBI's projections even before the crude oil price drop happened, and that was primarily because on the food side of the economy, we continue to see significant undershoot. And now with oil prices down almost $25 from the peak, the second half FY19 projections, in our view, look to undershoot almost by 100 basis points. And even in the April to June of 2019, we think that inflation could be close to 50-odd basis points below the projections. So I think a combination of positive supply side forces coming in from oil, from food, and also to an extent on the rupee is now sort of combining with the demand shock that we think will play out because of the tighter financial conditions, which will also bring down core inflation with a lag. So yes, there is a case for a significant downward revision on the inflation trajectory.
Okay, we'll have to wait for core inflation to come down. But Sajid, first, do you agree with Sonal about the need to lower the inflation forecast? And also, will they do anything to their growth forecast?
Well, I want to first sympathize with policymakers for having to make policy with this extraordinary volatility. When oil prices move $10 every week, for example, it's very hard to actually track these moving parts. I largely agree with Sonal. I think what you're seeing is both, since the last policy review, a very different global and domestic macroeconomic environment. We should spend a minute on what's happening globally, which is I think global growth risks are now skewed firmly to the downside. US growth was driving the global economy. That's going to fall off as the fiscal stimulus fades. Europe disappoints to the downside, and China's growth risks are also skewed very much to the downside. So I think that itself exerts some disinflationary forces. If you were to add that to the fact that oil is 30% lower, that you've had this now 5-year process of food disinflation, there's clearly a structural, secular component to it. This is not about 1 month or one commodity. And I agree with Sonal. I think in India's growth risks are skewed to the downside. There is a tightening of financial conditions in the NBFC sector. Remember, at the margin, their growth, incremental growth was a third of what the banking system was providing. So it's hard to imagine that kind of growth rate continuing. But remember also, I think the government is committed to the fiscal deficit number. And my sense is we may have to experience some expenditure compression in the coming months to meet that fiscal deficit number. Now, there are offsets here. One offset is oil at 60 versus oil at 85 means the negative terms of trade shock from oil is much lower, if any, compared to last year. And secondly, the rupee is down in trade-weighted terms 10%. And that should have some expansionary impact, even though that will be offset by weaker global growth, right? And you must disentangle the two. Bottom line, I think there's enough evidence to suggest that a downward revision in the inflation forecast is now warranted. Like Sonal, we're about 50, 60 basis points below. On the growth front, given the uncertainty, I would just perhaps expect the RBI to flag that the risks are to the downside without having to change numbers materially at this point, just given the quantum of uncertainty.
Okay. Hold on, Sajid. Dr. Sen, I'll come to you in the end. Let me get all the members of your committee first to speak about their growth inflation worries. Soumya, can you take off from where Sajid left off on growth? Even the second quarter, second quarter had a positive base, 6.3 only a year ago. And the debt crisis had not hit, IL&FS and the tightening of the debt market happened only after September 20th. With all that going, it was only 7.1%. So isn't there a worry? And even credit growth, as Sajid pointed out, NBFC credit growth, is it really being made up by banks?
No, I think that's a valid point in terms of the growth consideration, what Sajid said. And my sense is that growth is going to pick up, going to slow down significantly in the second half. In fact, the growth rate...
So RBI will change the number?
I don't think it will change the number even, but it can actually flag the downside risks to growth. So that's one point. And the second important point is that I think everybody was expecting that the Q3, Q4 growth should decline. But the numbers suggest that the GDP numbers suggest that the growth has actually started her downhill in the second quarter. For example, if you look into the credit growth of the scheduled commercial banks, the total number this year has been around 3.3 lakh crores expansion, out of which 2 lakh crores happened in September. This number has declined to 30,000 crore in October. So that means the total incremental credit expansion in the month of October for all scheduled commercial banks is 15% of that what happened in September. So out of 3,20,000, 2,30,000 is in September and October, and the rest 90,000 is from April to August. So that means the monthly run rate was 18,000 crore from April to August. That is now at 30,000 in October. So we are actually mean reverting to the trend growth rate, which is from April to August. That's not a good sign. And we are witnessing and credit slowdown across all sectors. Industry has been negative. In fact, the agricultural credit is also growing at a much slower pace because of the drought condition and loan waiver. So my sense, and NBFC credit growth, which was at around 56,000 crore incremental in September, is now around 16,000 crore. So all evidence suggests that possibly the growth slowdown has come a little earlier than anticipated, and my sense is that the Q3, Q4 numbers, we could be in for some amount of moderation, which could be
sub-7.
Sub-7. It would be definitely sub-7 because we're already running with a sub-7 number for Q4 and with a 7.1% growth number for Q2. I think second quarter numbers could have a significant downside.
Okay. Samiran, I think the growth inflation argument has been made quite strongly. What about liquidity? I mean, is it time the Reserve Bank actually flagged that they would like not just neutral but maybe even surplus liquidity? And can they do something about it other than just OMOs?
I mean, if you see the concept of having a neutral liquidity stance, it's tough to change it very quickly. It has to be more of a thought-through decision. Now, opportunistically, you can change this depending upon what your growth inflation dynamics is. But I suspect even to come back to neutral liquidity and maintain neutral liquidity in the Jan-March quarter where seasonally things are tighter, and as Sajid was mentioning, if there is some kind of fiscal compression, then liquidity will be even tighter beyond what the seasonal tightening is. So the requirement for OMOs are substantially higher over the next few months. The only thing that has changed is that because of lower oil prices, the BOP incrementally could turn positive. So to that extent, RBI has the option of buying FX, which is killing two birds with one stone. On one hand, you can replenish the FX reserves, and on the other hand, you can infuse rupee liquidity without having to do OMOs. So that option is very much there. And outside chance is a CRR cut as well. But I suspect that when RBI has just changed to a calibrated tightening stance in the monetary policy, CRR has somewhat of a connotation of monetary policy associated with it. So that might not be the one which gets used so early in the day.
Well, the Reserve Bank in a previous analyst call had not thought very highly of CRR as an instrument. They're very clear that liquidity is tackled by OMO. rates are tackled by repo, inflation is tackled by repo. They want that cleanliness of instrument. So I'm not very sure whether they're going to look at, but we'll discuss the CRR. I wanted to pick the other side, Dr. Sen, if there is one. I mean, there can still be fiscal slippage. We don't know what the election results on December 11th will be, but a desperate government can spend more. The fiscal numbers that came looked extremely difficult. Already by October, it's like 3% more than the fiscal deficit for the full year. Tax revenues are hardly picking up. If you looked at direct and indirect, I think the tax revenue growth is 4%. It is not even near nominal GDP. And core inflation is still above 6. Sir, is there another side?
Yes, there is, in fact. Look at what's happening. On one hand, you've got a situation where the overall growth rate of the economy has been weakening steadily over the course of this year. And things are starting to look a lot worse now, as I think Shomwan particularly pointed out. Now think of the government's problem. We are already in December. If they want to give a fiscal stimulus, the only way they can do it is that if within the next couple of weeks they come up with a fresh set of demand for grants. Okay? I don't think that's happening. The time is too short. There is complete unpreparedness for it. So on that front, seeing additional expenditure commitments, I don't think is going to happen. The question is that if they were planning to actually cut back on certain forms of expenditure or delay the payouts, that may not happen. They may actually go ahead with the expenditure program as given in the budget. That's about the maximum they can do. So I wouldn't worry about a fiscal stimulus per se in the coming quarter.
Okay.
What I would factor into account, on the other hand, is the fact that the next quarter will be the pre-election quarter. And historically, the pre-election quarter has seen all political parties open up their war chests and start splurging. Now, that's a demand boost which has happened almost every time before, and it's more than likely to happen this time, perhaps even more than earlier. Now, that's the only silver lining that I can see on an otherwise rather dismal real economy trajectory.
So, therefore, the position is that it is weak inflation, weak growth that the MPC will have to counter. You agree with that?
I completely agree with it.
Okay. Well, with that agreement of the chairman with the members, let's take our first break, and then we are going to ask for what can the MPC do if this is the picture that they are going to paint in a minute after this break.